Hey everyone, and welcome to this month's commentary on the myStockDNA model portfolios. We're here to give you the latest insights into how the market is shaping our portfolio allocations.
That's right. Each month, we take a closer look at how the models are adapting, but we also like to dig into some of the key concepts behind how the models are actually constructed. It's more than just numbers. There's a lot of thought and strategy behind.
And for those of you who are new to the podcast or just need a refresher, we highly recommend going back to some of our older videos. There's a lot of great content that explains the foundation of these models and how they work.
Yeah, definitely. Whether you're a seasoned advisor or just starting out, these past videos will help you get a better grasp on the models and the strategy behind myStockDNA. But for now, let's dive into what's happening this month. Before we move on, we have to make a quick stop. It's time for the legally required disclaimer.
Yes, the necessary pause before we dive into the real meat of things. For those of you following along, this is your cue to pause the video or audio if you need to review the disclaimer in detail.
This month's commentary begins with a look back at 2025, a year that reinforced a simple but often overlooked truth in investing. Returns only matter in the context of risk. Before we dive in, one important note. All performance numbers shown here represent gross model returns. They do not include trading slippage, transaction costs, advisory fees, or taxes. The purpose of this review is to evaluate relative performance and risk behavior, not to present realized investor returns. Now let's start with what we call the players, the individual strategies that powered the portfolios throughout the year. At the top of the scoreboard, you see the benchmark to beat, the S&P 500. In 2025, it delivered a 17.7% return with a peak drawdown of 7.6%. That translates into a return to risk ratio of about 2.3. A solid year, but with meaningful volatility along the way. Looking across the strategies, you'll notice something important. The top performer in raw return terms was the SMAi TQQQ and Friends strategy, which delivered a 44.1% CAGR. That's offensive firepower at its best. But the most valuable player of the year was not the highest return strategy. It was the defensive one. The SMAi defensive ETF strategy with quarterly rebalancing posted a peak drawdown of just 0.2% while still delivering strong returns. Its return to risk ratio came in at an extraordinary 96.3. That's not a typo. It means this strategy generated dramatically more return per unit of risk than the benchmark. In fact, the majority of strategies on the scoreboard outperformed the S&P 500 on a risk-adjusted basis, even when they did not beat it on raw return. That's the core Moneyball insight. You don't need every player to hit home runs. You need the right mix of skills that complement each other. Which brings us to the portfolios, the teams built from those players. Here, those individual strategies are combined into risk-targeted portfolios, ranging from conservative to aggressive. Again, the S&P 500 sits at the top as the reference point. The conservative portfolios stand out immediately. The UMAi conservative portfolio delivered just under 15% for the year with less than a 1% drawdown. That produced a return to risk ratio more than 7 times higher than the benchmark. In the moderate category, portfolios matched or slightly exceeded the S&P 500's return, but with significantly lower drawdowns. In growth portfolios, returns remained competitive while volatility stayed controlled. But the aggressive portfolio, this is where the story changes. Despite the name, it didn't outperform. Why? One reason, the SMAIF NGU and Friends strategy that you saw in the previous slide. That particular strategy had been a slugger in prior years, swinging for the fences and connecting big. But in 2025, the market was choppier. Instead of a clean upward trend, we saw whipsaw moves and a V-shaped rebound. That's a rough environment for leveraged momentum plays. FNGU and Friends struck out more than it connected, dragging down the whole aggressive portfolio before being benched. Think of it like a cleanup hitter who thrives when the pitch is slow and steady, but gets fooled when the market throws curveballs all season. Even the best power hitter can underperform when the pitcher changes rhythm. And that's the lesson. Even the boldest strategies need the right conditions. And when they're part of a team, their strikeouts can hurt more than their home runs help. Now let's turn to what's changing as we move into 2026. Compared to December, January allocations show a modest increase in equity exposure, particularly in moderate and growth portfolios. But under the hood, This is not a shift toward aggressive high beta stocks. The increase is coming from a rotation into more defensive equities, businesses with steadier cash flows and more resilience if growth slows. At the same time, crypto exposure has been reduced to effectively zero across all portfolios. While I remain bullish on crypto over the long term, Darwin viewed the sharp drawdown that began in October as a potential structural event, a kind of market heart attack rather than a routine correction. In response, the model prioritized capital preservation and stepped aside. Exposure to interest rate hedge ETFs has also re entered the portfolio after taking a break the last month. Gold remains a core holding, and dollar exposure has stayed relevant as a hedge against uncertainty. This is not a risk off stance, it's a risk managed one. From a macro perspective, EQ, our AI economist, currently sees the economy leaning toward inflationary growth. Fiscal stimulus and tax policy are supporting near term expansion, but inflation remains sticky, labor markets are cooling, and consumer confidence is fragile. At the same time, gold's strength and crypto's weakness suggest that tail risks have not disappeared. As a result, Darwin is doing what it does best. It is staying invested but staying balanced. It is predicting regimes but relying more heavily on reaction as market signals evolve. And it is adjusting exposure dynamically rather than chasing headlines. As always, the goal is not to win every month or every quarter. The goal is to win by not losing, quarter by quarter, drive by drive. Before we wrap, a quick programming note. We're skipping the usual podcast interview this month to answer a request we've been getting from a number of advisors. As capacity on Darwin has grown, so has the interest in tools to help explain how it works, especially for clients. So, in addition to the tools we have on our website, we've put together a couple of explainer videos that walk through the core ideas behind Darwin, what it does, how it manages risk, and why it behaves the way it does in different markets. You'll find the links to both videos in the show notes. The first one is about 20 minutes long. It uses simple analogies. Think investing meets baseball and driving, and dives into some of the behavioral finance insights that inspired the system. The second is a 10-minute origin story. It walks through why Kumar and I started myStockDNA in the first place and how that mission shaped Darwin's design. For a copy of the slides used in the videos and to remix it to create your own sales collateral, just shoot us a note. Happy to share. We are also launching an ETF later this year based on the UMAi growth model with Thor as the advisor and AI Alpha as the sub-advisor. In addition to providing a tax advantage, we will also be using the ETF in our own models to further improve the return risk profile. Stay tuned. That's it for this month. Wishing you all a great start to 2026. It's shaping up to be a loud year in the markets, with strong opinions on both sides and plenty of volatility in between. But with Darwin's seatbelt fastened and the game plan in place, here's hoping your portfolios ride smoother than the headlines. Talk soon.